Hey everyone, I'm Mike.
And I'm Jose.
Today we're going to be talking about the current market situation. It's kind of changed. We're in December of 2022, and we've seen some slowdowns, if we have to be just completely real with people.
Remember, most consumers today get most of their information from the television. So if they make a decision, whether they spend money or they buy stock or they buy real estate or they sell stock or sell real estate or buy Bitcoin, whatever it might look like, they're taking their cues from TV. So of course the media outlets that are providing all the information to the consumer may be just providing them a general outlook of what's happening in our nation as a whole. And we recommend that if you are taking any information from these media outlets, that you're seeing how you're affected locally and how your state or your county is reacting to the overall temperature. So what we're talking about today is the rise of inflation and the rise of interest rates, which are now making it so a lot of consumers are afraid to purchase real estate because they think that they're not going to get a good deal because interest rates are 7%, or just most recently 6.85, and because they might think that there's going to be a big crash.
That's where the mainstream media has stuff, but also if you go to social media, like everything that gets millions and millions of views is the Chicken Little, the sky's falling, everything's going to crash.
The sky is falling! The sky is falling!
I don't know if that's actually, I don't have a crystal ball, but I don't think that's going to be true based on what we're doing. A lot of people go back to 2008
that's what they
and compare it to 2008.
Yeah, they think that's going to happen all over again.
And I can tell you, that's different.
It's different.
Yeah.
And a lot of people I talk to right now, they're saying, well, we're just going to hold off and not buy any real estate because we want to wait till the market takes a bit of a dip or a crash so we could come in and get all these good deals.
Yeah.
So that's usually a reoccurring theme that we hear. So let's talk about what happened in 2008.
Yes.
And what caused the issue, and then we'll fast forward to today and we'll talk about what issues we're dealing with today.
Well, just really quick, today we're going through record inflation. Inflation means prices going up. Let's keep that in mind. Then let's go back to 2008, 2006, 2008. I was actually a home buyer at that time. I bought 3 homes in that particular point in time. And pretty much it was very, very easy to get a mortgage, to say the least.
So what they had was there was very loose restrictions and on lenders. Mm-hmm. So a lot of times there was, back in the day, all these lenders were providing funding or money to home buyers to purchase homes, and the level of access to money was the bar was set very low.
Yeah.
And what started all this was subprime mortgages.
And they were wrapped up as good mortgages when they were selling them, reselling.
And stated income only mortgages.
Yeah.
So they literally would go to somebody and say, hey, you want to buy this $400,000 house? Sure, can I get some information from you?
Sure.
Okay, so first thing is, do you have a job?
Yes.
Great. How much money do you make annually?
I make $1 million a year.
Okay, and how long of a loan do you want to do? Do you want to do a 30-year loan?
I'll do a 30-year adjustable rate.
And is this going to be your primary or is this an investment?
It's primary.
Okay, sure. Now, we're going to go ahead and pre-qualify you and pre-approve you for this loan. It's stated only, so these
literally like that. Yeah.
Like that. And a lender would say, wait, you said you made $50,000? You mean you made 85, right? Because 85 is what we're going to need to make this deal happen. And buyers were like, yeah, sure, if that's what I need to make. And they were literally giving people mortgages for 1 or 2 or 3 different properties
that they literally couldn't afford.
And they weren't even looking at, there was like no underwriting really happening.
Yeah.
And it kind of made everything crazy because what happened was with these subprime loans, well, let's talk about the loans they were writing. They were like interest only loans.
Yeah. Or adjustable rates as well.
Or adjustable rate, where they're saying, hey, listen, you could technically afford this mortgage payment for the first 2 years because it's interest only. So you only have to pay $1,500 a month for this mortgage because that's only interest payments. You're not paying principal. But what happened was after 2 years of these interest only payments, the loan matured. And then on the 3rd year, now they had to pay principal and interest. And all of a sudden their mortgage payment went up by $800, $900 a month. And they're like, I can't afford to pay this. And guess what happened?
They stopped paying it. And they stopped paying it. What happened was then the bank started foreclosing. And at first it wasn't a big deal because there was a small amount of foreclosures. But those foreclosures led to inventory, meaning we had homes for sale on the market.
Too many homes for sale.
But then it was like a house of cards. Then it all came down. Then what happened was that $400,000 home is now worth $380,000, $350,000, and then the person who really can't afford the other $400,000 home is like, well, I'm making payments on this piece of property that's actually worth $50,000 less, I'm just gonna stop making payments on it, and then they can take it from me too.
So let me give you a perfect example. This is what happened in a community that I bought a home in. So I bought a home, it was about $420,000. This was gonna be my primary home that I was gonna live in. I got a loan, easy, trust me, the level of entry of getting a loan was down here. So I got a loan, I moved in, and about 6 months after I moved in, all of a sudden the housing market crashed. People stopped buying, people got scared, and all these homeowners that had built homes in these neighborhoods, they just started walking away from their deposits and not closing because they knew that they wouldn't be able to afford the payments because interest rates went up. And a lot of the people that own the homes that thought they were going to be able to flip it for a profit, all of a sudden they realized, wait, there are no more buyers buying property. How am I supposed to flip this property? And now they got stuck holding the bag. They got stuck with the property. And now they had 1 or 2 properties that they couldn't afford to pay the mortgage on. So they stopped paying the mortgage, and then it went into pre-foreclosure. And then there was a lot of short sales, which means a realtor will list your house for sale. And of course, you're shorting the amount that's due to the bank, and the bank will take what's left, what they can get, and there's a shorted amount that that owner didn't pay to them. And then some people said, you know what, screw that, I'm not gonna even do a short sale, I'm just gonna let it go into foreclosure, and the home just went into foreclosure. Now, a regular homeowner like myself that wanted to say, I don't wanna be in a neighborhood where all the homes are foreclosing and short selling, if I decided to put my house for sale, I can't put my house for sale for what I paid for it, $420,000, because now that guy's giving away his house, that guy's short selling his house, these 3 homes foreclosed, and the property value on my home instantly went down to about $350,000.
Yeah.
So now I was like, I'm stuck, I can't sell my house, and now I'm living in a neighborhood where all the values have depreciated.
And when you're saying interest rates went up, that's because people did the adjustable rate mortgages, which some are still doing now, and I would not work with a lender when interest rates were 3.5%, 4% that offered an adjustable rate, because it would be like
pointless.
It's unless someone's thinking about selling in a year, it's like really bad advice, and it's like the mortgage. Sometimes people are looking for their pocketbook instead of their customers' best interest. So that was what was happening there, and then all of a sudden we had all this inventory, and then the banks freaked out. And what did they do when they freaked out? They sort of tightened down that lending, didn't they?
So then all of a sudden the government introduced this new program, and they said, okay, now that we're starting to finally get back on track, we have to create new standards that the lenders will adhere to when lending money to the public. And that's when Frank Dodd came
So
out
that- yeah,
with
that's-
the rule of revision.
That's what happened afterwards. But mainly what happened was we had all these foreclosures come on the market. So of course we have a whole bunch of supply.
A lot of inventory.
And then at the same point, the banks stopped lending because you're going crazy with all this stuff.
They were shutting down. They were going into bankruptcy. They were closing their doors.
So then there wasn't very many buyers because people couldn't get qualified anymore. So you had very little demand and a huge supply,
inventory.
which made a collapse of 2008. That's what happened in 2008. Check out The Big Short if you haven't. There's a documentary and a movie on it.
Yeah, it's pretty
really
good.
Yeah.
And so what happened essentially is there was a lot of houses that were available and for sale. And everybody wanted to sell their house before the other guy did. So then he said, oh wait, his house is listed for 300, let's list ours for 290. And this guy said, he'd reduce it to 290, let's reduce ours to 280. So all this inventory on the market, but the prices were going down drastically and there weren't enough buyers for it. So of course the government says we need regulation, we need to put something into place where this won't happen again. Now, back in that time, the average interest rate was about 7 to 8%, or it was 7.25, 7.5% is back what it was back in 2006, 2007, 2008.
Which is relatively low interest, by the way.
Yeah, it is. And so what the Fed did was said, how do we fix our housing crisis? Well, let's reduce interest rates, so make it more affordable, so buyers who are, because a lot of buyers lost faith in the housing market, and they were very scared to go out and be part of home ownership because they saw what happened to everybody else. So the government says, well, if we reduce our interest rates low enough, buyers will have the confidence to come back out and purchase some of these homes because we have tons of inventory. So they did reduce interest rates, and a lot of buyers did come back and buy a lot of these properties. Now, here's the problem. When that happened, the government said we need to introduce new rules that will protect the consumers from predatory lending and make sure this problem doesn't happen again. That's when Frank Dodd came out with all of its rules on how lenders can lend money to consumers.
Yes.
Which brings us to today.
Today is completely different. So anyone that's saying that we're having another crash like 2008, no matter what happens, this is not like 2008 because we don't have this situation. What we're having today is that we have what's called inflation. Inflation happened when, everyone knows what's happened in the last 2 to 3 years. The whole economy sort of came to a screeching halt when we had the illness going around. And when that happened, we saw prices going up and stuff. Gas,
There was huge subsidies from the government.
Yeah.
Everybody was home, but
we gave trillions away, which
we were
means
still making lots of money. So a lot
Yeah.
of people were working home. They're still making lots of money. The stock market went through the roof, and the government was providing subsidies and paychecks to all these people at home. So what happened? All these people, they're bored. They're still making money. They don't have anything to do. So what do? They start spending at an uncontrollable rate.
And it makes prices go up. Prices of lumber went up. Pretty much the prices of everything. You can't find a car. It took, it's like a 2-year wait to get some cars, or 6 months, depending on what type of car you're getting. And everything's just going up in value. It's inflation. So what the government has to slow inflation is to increase the interest rate, which is what they did.
And so, like, if we look at this, this is a highlighter I'm holding in my hand. Now, imagine if there aren't many of these highlighters around. I have one of the very few that are around. This is a very valuable commodity or very valuable highlighter because there aren't many around. But what happened was during COVID or after COVID, the dollar became very available to a lot of people. Especially with these subsidies the government was handing out, they were just they were literally writing checks to people at home. They were writing checks to businesses. Anybody could qualify for this free money. So now all of a sudden, this one rare highlighter, now everybody had one. So now, which is the dollar, now everybody had just as many dollars floating around. So the dollar wasn't as valuable as it once used to be, which caused inflation.
Yep.
So now the government says, well, how do we get a hold of this inflation? Well, guess what? We have to make everything more expensive so people start spending less money.
Yeah.
And in the process, guess what got caught up with that? The housing market. So as the feds increase their overall rates from the government, then all of a sudden lenders, it became very expensive for them to borrow money to then provide borrowing to consumers. So now less consumers can borrow money at an affordable rate, so less people are spending money.
The big losers in all this were people that bought new construction, like they 6 months, a year ago, and they got qualified for a 3.5% interest rate, and they put a $50,000 deposit down, and then all of a sudden the interest rate goes up to 7%. Their DTI income, the debt to income ratio, changes, and now they can't afford the house. And now, with some builders, they lost the $50,000. With other builders, they're working with them to try to get them a smaller house. That's probably the biggest victim of this interest rate hike.
Yeah.
But on top of that, it makes houses a lot more expensive to afford when you're actually getting a loan on the house.
Now, the interesting thing, if you look at the market that we're in currently here in Central Florida, is what we're speaking about primarily, because this is what we know. Mm-hmm. If we look at it, we look at our inventory and we say, okay, how is our inventory looking? Do we have too many homes for sale and not enough buyers? No, we actually have the opposite problem. We have enough homes for sale. We could use more, but we have enough homes for sale currently for the amount of buyers that we have. So we don't have a huge influx of listings that can't be sold. There's enough listings for the buyers
pretty
that
balanced
we have,
right now, actually.
and they're buying houses. Buyers are able to negotiate better terms now, but there's enough where the market is kind of more it's more of a regular market that we're in, which a lot of realtors and buyers can appreciate, that we can actually go to a house that they're interested in and actually negotiate with these sellers and have it a two-sided transaction than just a one-sided transaction, where before, when there was no inventory and we had 1,000 buyers but only had 100 homes for sale.
Yeah.
That was
crazy. That was a year and a half ago. Literally, we'd have 40 offers on every single listing. We sold about double the amount of houses that we typically would sell. Now we're back down to selling about 4,000 houses a month. So we're actually over half less of what we were at the top of it. But we don't have very much inventory, but the buyers are a lot less now. It's relatively balanced. It's just not very many buyers out there. So realtors went from 16,000 realtors in this area to 24,000. So the realtors are struggling because there's a lot more realtors and we have less inventory and buyers to sell. But it's a balanced market, so I just don't see the home values going down. I see realtors possibly being in trouble because there may be too many realtors until that evens out. But as far as the amount of buyers and the amount of sellers, is relatively balanced right now.
And you guys, there's a weird cycle in the world of real estate or the financial world where typically, every 13 years on average, there's a correction or a curve that takes place. Do the math. So from when the housing crisis started in like 2008, 2009, 13 years later, we're having that COVID situation that came up. And because of the COVID situation, some type of financial crisis comes from that. Yeah. And then that's kind of where we're at today. Now, does it affect the housing market? Does it affect the stock market? Where does it hit? I don't know. This time, I think it's more hitting the financial markets than anything else. But if you look online right now and say, do we have an inventory problem where there's too much inventory? The answer here in Central Florida is no. Also, do we see a lot of pre-foreclosures and foreclosures on the market?
No.
No.
Well, that's a big difference between now and then. There was like you bought a house for $420,000 is now worth $350,000, and you have a 7% interest rate, and interest rates are still 7% at that particular point in time. So that was an unbalance. Now here's the difference now. If you bought a house 2 years ago, you got a 3.5% interest rate. So even if houses went down $100,000, you're still got a better payment right now than if you bought the cheaper house at the higher interest rate. So no one's going to walk away from the 3.5% interest rate. So I don't see us having this influx of foreclosures or people stop paying because people have a 3.5% interest rate. Why?
Yes.
I don't want to change my house. I can get a bigger house now, but I'm sort of stuck where I'm at right now because I have that 3.5. I can't walk away from that low interest rate.
Yes, and the saving grace that we have is we have a lot of buyers that purchased a lot of homes. But all those buyers that purchased those homes bought it at an extremely low interest rate.
Yeah.
So that means that even though there's some turmoil in the market or the financial market, the mortgage payments are so damn affordable that people aren't running into a crisis situation where they can't afford to pay their mortgage or they're walking away from
They're going to go,
deal.
if they walk away, they're walking into a more expensive rental.
Yeah.
Like the rents are more expensive than what a home to purchase 2 years ago was. So and that's where I'm seeing that we might have less inventory because people are not going to want to sell, and then we're going to have to wait for buyers to get used to the 7% interest rates, which are still historically low. But I think what we're going to have to wait for is some of the incomes to come up. Meaning, because of the inflation, if people are still making $10 an hour that were making $10 an hour before, we're going to have to wait for that salary to come up. And once that salary comes up, then we're going to have it back to a balanced market.
Or someone's going to have to get realistic and realize that they're not giving money away for free. So they have to kind of go back on their budget and say, okay, fine, we can't get a $700,000 house. I guess we'll have to settle for a $550,000 house. Right?
That's exactly what happened in 2000 when I bought my first house. It was at 7%. At the time, it was a $117,000 house, which is about $420,000 now. And I bought it at 7% interest, but it was a 1,700 square foot house. The last few years, with that same sort of salary adjusted for inflation, I would have been able to buy a 3,000 square foot house with that same job. But then I just bought a 17, but I still was able to sell it 2 or 3 years later and walk away and actually make money when I sold it. And I think that's what people don't understand is that they wait. If the prices continue to go up, they're still probably better to purchase now than if you wait for the interest rates to come down, you may be waiting for a long time. They may not come down. And if they do come down, you can refinance.
Yeah, or you could just continue to spend the next year or two paying these, overpriced rents that are out there and just wasting the money and never getting it back.
I don't know if they're overpriced. They may be that's what the market's saying they are right now. They're high and a lot of people can't afford, but that's more of a, we need to get our incomes up.
Yeah. So guys, if you saw this video and you like what you heard, please, make sure you subscribe and you can watch our other videos as well. But watching videos like this is going to inform you about what's happening to our market, make you a better educated agent, and it probably provides you with better talking points when discussing real estate with potential buyers and sellers.
Yeah. And of course, if you're in Central Florida and want to come and talk to me and Jose about coming working at Preferred Real Estate Brokers, I'd be more than happy to talk to you if you're thinking about getting your real estate license or have your real estate license with another brokerage.
Yep, and that's all we got for you today. So we'll see you next time. Thank you so much.
Take care. Bye-bye.